Let me give you the real numbers on what happens if you freelance for 20 or 30 years and never save for retirement. Not the scary lecture version, the actual math. Because most freelancers understand they should be saving. What they don't understand is what the gap actually costs them in concrete dollar terms. Here is the situation. Research from Aviva published in early 2026 found that 34% of freelancers are not taking any steps to prepare for retirement. Not a small percentage, more than 1 in 3. And only 16% of freelancers have access to any kind of formal retirement plan, compared to 52% of traditional employees. That gap in access is real, but it does not explain the full story. The tools exist for freelancers to save aggressively for retirement. The problem is inaction. Let's start with Social Security. Because every freelancer pays self-employment tax, 15.3% on your earnings, split between Social Security and Medicare, you are building some Social Security benefit. That matters. But here is the reality. Social Security is designed to replace roughly 40% of your pre-retirement income for average earners. If you earned $80,000 per year as a freelancer, your Social Security benefit at full retirement age might be around $2,200 to $20,500 per month. That is roughly $26,400 to $30,000 per year. Can you live on that? Some people can. But it is a significant lifestyle reduction from $80,000 per year. And for early claimers at age 62, the benefit is reduced further. Benefits shrink roughly 25% to 30% if you claim before your full retirement age. Self-employed people who try to continue working while claiming early benefits also face an annual earnings limit. In 2026, that is $24,080 before their benefits get reduced. The point is this. Social Security exists. You have earned it. But it alone does not provide a comfortable retirement for most people who are accustomed to professional income. Now let's look at what saving actually does over time, because compound growth is the part most people underestimate. If you are 35 years old today and you start putting $400 per month, $4,800 per year, into a retirement account earning an average of 7% annually, you will have approximately $453,000 by age 65. That is 30 years of steady saving at a modest monthly amount. If you can increase that to $1,000 per month, $12,000 per year, over the same 30-year period at 7%, you will have approximately $1,131,000. Over $1 million from $1,000 per month. What does the freelancer who saved nothing have at 65? Their Social Security benefit, and whatever they manage to accumulate in taxable savings, real estate, or other assets. No tax-advantaged compound growth. No deductions in their peak earning years. Just Social Security and whatever they scrape together without a plan. The tax deduction piece is the part freelancers most often miss. When you contribute to a solo 401k or SEP IRA, those contributions reduce your taxable income in the year you make them. A freelancer earning $90,000 who contributes $20,000 to a solo 401k only pays income tax on $70,000. At a 22% rate, that is $4,400 in immediate tax savings, on top of the long-term compound growth. Freelancers who never save for retirement are not just missing out on future wealth. They are overpaying taxes every single working year of their freelance career. Let's talk about the accounts available to you in 2026, because this is where many freelancers feel overwhelmed and just do nothing. Solo 401k is the most powerful option for most freelancers. In 2026, you can contribute up to $24,500 as the employee portion plus up to 25% of your net self-employment income as the employer portion, with a combined limit of $72,000. If you are 50 or older, you can add a $7,500 catch-up contribution, bringing the total to $80,000. If you are between 60 and 63, the catch-up is $11,250, making your total limit $83,250. These are the highest contribution limits available to any self-employed person. The SEP IRA is simpler to set up and maintain. In 2026, you can contribute up to 25% of your net self-employment income, capped at $72,000. If your freelance income is $80,000, you could contribute roughly $14,800 to a SEP IRA. No payroll, no quarterly elections, just a single contribution by your tax deadline. The simple IRA has a 2026 limit of $17,000 or $21,000 with a 50-plus catch-up. It is less commonly used by solo freelancers but is an option if you have employees. The traditional or Roth IRA has a 2026 limit of $7,500 for those 50 and under. It is the simplest to open but has the lowest contribution limits. Still useful complement to a solo 401k or SEP IRA. Here is the scenario that plays out differently based on whether you saved. Freelancer A earns $80,000 per year for 30 years and never contributes to retirement accounts. They reach 65 with Social Security, maybe $2,200 per month, and limited personal savings. They live on $26,400 per year in retirement. Freelancer B earns the same $80,000 per year and contributes $15,000 to a SEP IRA each year for 30 years. At 7% annual growth, those contributions compound to approximately $1.5 million. At a 4% safe withdrawal rate, that is $60,000 per year in retirement income from the portfolio alone, plus Social Security. They retire on $86,400 per year. The difference between those two scenarios is not income. It is habit. It is setting up the account and making consistent contributions. Here is what you need to do. Open a solo 401k or SEP IRA today. Both Fidelity and Vanguard offer no fee. Solo 401k accounts. Fidelity's Solo 401k has no annual fees and no minimum balance. You can open one this week. Decide how much to contribute. Even starting with $500 per month matters. Increase it as your income grows. Automate the contribution if you can. Set a recurring transfer from your business checking account after each large client payment. And if you are behind, know this. The catch-up contribution rules for ages 50 to 63 exist specifically for people who did not start early. The system gives you a path to accelerate. The freelancers who thrive in retirement are not necessarily the ones who earned the most. They are the ones who use the tools available to them consistently over time. Subscribe for more retirement planning strategies built for freelancers. See you in the next one.